Munro Marx. Welcome to episode 2 of Zurich Marine Insurance. In the last episode, we specifically looked at cargo insurance and the definition of cargo insurance. In this episode, we will discuss basic definitions and concepts under our marine cargo product. So I'd like to briefly refer to the main modes of transportation used getting goods from origin to final destination. Starting with sea or waterborne transportation, mainly used for goods with a low value but high volume or high weight. These goods include things like home electronics, car parts, foodstuffs, and others. Air transportation is used for goods which have high value and low weight ratio. This is the fastest way of getting goods around the globe. So the Incoterm rules are a set of standard terms issued by the International Chamber of Commerce. These trade terms are used in international commercial transactions and also in the procurement processes of goods. The intention of these three-lettered terms is to clearly communicate to the seller and the buyer what their tasks, costs, and risks are associated with the transportation and delivery of the goods. All parties need to be aware of where the risk would transfer from a seller to a buyer. This will then determine where an insurance contract will start and where an insurance contract will end. When we look at the Ex-Works Incoterm, it states that the goods or the risk transfers from the seller to the buyer at the origin warehouse or origin named place. A more tricky Incoterm and also customarily used in international transactions is CIF or cost, insurance and freight. This is where the seller delivers the goods to the buyer once it's loaded safely onto a seagoing vessel on its way to the final destination. Under this Incoterm, the seller actually arranges the insurance contract or the marine cargo insurance contract up until the port of discharge. However, the risk of physical loss or damage is transferred to the buyer once it's loaded onto the ship in the loading port. For general cargo, 3 main institute cargo clauses is used. An institute cargo clause A, an institute cargo clause B, and an institute cargo clause C. Cargo clauses A would constitute a all-risk type of cover under a marine insurance contract, where institute cargo clauses B would be a little bit more restrictive, and cargo clauses C is your most restrictive cover. The marine insurance contract would have other clauses, terms and conditions that support or is others substituting some of the covers under the institute cargo clauses. For other cargoes such as oil, trade or timber, a different set of institute clauses would apply. Besides the institute cargo clauses, customers must also be aware of other risks in the supply chain, for example strikes and war. Many other risk management considerations such as packaging, protection and preparation of the cargo and also crime issues will be discussed in the next few episodes. It's very important for a seller and a buyer and any other party like an insurance broker and an insurance company to be aware of global trade and economic sanctions. Why? Because the insurance policy might not always reach into such a country. There might be issues around the commodity insured if there's sanctions on that commodity, and also that insurance claims might not be considered in certain territories. At Zurich, we have access to state-of-the-art tools. We can therefore provide expert advice, services, and also support when customers import and export goods. Reflecting back at the content of episode 2, it's important for a customer or a broker to get into contact with a Zurich Marine Insurance specialist to ensure that the basics are covered under a marine insurance policy and minimizing the risk.